We begin with Chapter 22. In this chapter, we will analyze in detail the Long Condor strategy. The Long Condor position is used when the market outlook is neutral around the strike prices of the short options. The strategy consists of buying one option, selling one option with a higher strike price, selling another option with a higher strike price than the previous one, and buying one option with a higher strike price than the short options. All options must have the same expiration date. The options must be all calls or all puts, and the strike prices of the long options must be equidistant from the strike prices of the short options. Here we can see the risk graph of the position. What we are seeing is a graph with two axes. On the vertical axis, the profits and losses of the position are indicated, and on the horizontal axis, the stock price is indicated. It is important to mention that the graph indicates the profits and losses per share on the expiration date of the contracts, and besides, the values do not include brokerage commissions. In the Long Condor strategy, the strike prices of the short options are called body. On the other hand, the strike prices of the long options are called wings. Therefore, the debit paid to initiate the position is equal to the lower wing premium plus the higher wing premium minus the lower body premium minus the higher body premium. That is, it's the difference between the premium paid and the premium received. The maximum profit on this strategy is limited. The most we can make is equal to the difference between the strike prices of the lower body and the lower wing minus the debit paid multiplied by the number of shares. On the other hand, the maximum loss that we are exposed to is also limited. The most we can lose is equal to the debit paid multiplied by the number of shares. As we said, in the Long Condor strategy, the strike prices of the short options are called body, and the strike prices of the long options are called wings. In general, the body is composed of an in-the-money option and an out-of-the-money option, and therefore the wings are also composed of an in-the-money option and an out-of-the-money option. This strategy has two break-even points, a break-even point to the downside, called break-even point 1, and a break-even point to the upside, called break-even point 2. Break-even point 1 is equal to the strike price of the lower wing plus the debit paid. Break-even point 2 is equal to the strike price of the higher wing minus the debit paid. The break-even points define the profit and loss zones. In our case, for stock prices lower than break-even point 1 or higher than break-even point 2, we are in a losing situation. In contrast, for stock prices between break-even point 1 and break-even point 2, we are in a profitable situation. When the Long Condor is structured using calls, it can be thought of as the combination of a bull call spread and a bear call spread. In contrast, when it is structured using puts, it can be thought of as the combination of a bull put spread and a bear put spread. Continuing with the analysis, the initial margin required to open the position is equal to the 100% of the total debit paid. An increase in volatility typically hurts the position. Time decay typically helps the position. With respect to exit conditions, to close the position, we must buy the short options, that is the body, and sell the long options, that is the wings. If the stock price is higher than break-even point 1 and lower than break-even point 2, we are in a profitable situation. Otherwise, we are in a losing situation. In this graph, we can see the influence of time decay on the position. On the vertical axis, the profits and losses of the position are indicated, and on the horizontal axis, the stock price is indicated. The blue curve indicates the profits and losses at trade initiation. As we get closer to options expiration, the curve of profits and losses is like the one shown in green. And, finally, at options expiration, the curve of profits and losses is the one shown in red. For this strategy, time decay typically helps the position. Let's see an example of how this strategy works. Here we are seeing the stock chart of the Microsoft company. As we can see, during the months of July, August, September, and October 2011, the stock was trading in a range between $24 and $28. In particular, for the last 2 months, the stock defined a support at $24.25 and a resistance at $27.5. As we said, during the months of July, August, September, and October 2011, Microsoft was trading in a range between $24 and $28. In particular, for the last 2 months, the stock defined a support at $24.25 and a resistance at $27.5. If we expected that the stock would stay in that range for the next few months, at that time, we could have entered a long condor. At the close of November 1st, 2011, Microsoft was trading at about $26, while the options expiring in November 2011 had a premium of 18 cents for the 24-strike puts, 38 cents for the 25-strike puts, $1.44 for the 27-strike puts, and $2.25 for the 28-strike puts. Thus, we could have bought 10 puts with a strike price of $24 and expiration in November 2011 at 18 cents, sold 10 puts with a strike price of $25 and same expiration at 38 cents, sold 10 puts with a strike price of $27 and same expiration at 1.44, and bought 10 puts with a strike price of $28 and same expiration at 2.25. With the 10 contracts, we would be in control of 1,000 shares. So the Long Condor would have cost us 61 cents per share, that is, $610 overall. The maximum profit is given by the difference between the lower body and the lower wing, minus the debit paid, multiplied by the number of shares. In our case, 25 minus 24 minus 0.61 multiplied by 1,000, which is equal to $390. When trading a Long Condor, it is usually best to use contracts with the shortest time left to expiration, that is, the front month options. After initiating the trade, the stock was trading between $25.7 and $27.2 for the next 2 weeks. Finally, on November 16, 2011, it closed at $26.07. In this example, the Long Condor was structured using puts because the cost of placing the trade was lower than by using calls. As we said, we initiated the trade on November 1st, and during the next 2 weeks, the stock was trading between $25.7 and $27.2. Finally, on November 16, it closed at $26.07. At that time, the options had a premium of 1 cent for the 24-strike puts, 2 cents for the 25-strike puts, 95 cents for the 27-strike puts, and $1.95 for the 28-strike puts. If we had closed the position at that time by selling at 0.01, buying at 0.02, buying at 0.95, and selling at 1.95, we would have received a credit of 99 cents, so our profit would have been 38 cents per share, because we had placed the trade at a debit of 61 cents per share. Thus, we would have had a total profit of $380, making a 62% return on investment in 15 days. That is, we made $380 by investing $610. So we would have made the 97% of the maximum potential profit for this strategy, which was $390. 2 days later, on expiration Friday, November 18, the stock closed at $25.3. That can be seen here. 2 days after November 16, on the expiration date of the options, the stock closed at $25.3. At that time, the puts with the strike prices of 24 and 25 expired out of the money, while the puts with the strike prices of 27 and 28 expired in the money. So the 27 strike puts would be worth $1.7 per share, and the 28 strike puts would be worth $2.7 per share. Therefore, if we had held the position to expiration, we would have received a credit of $1. So our profit would have been 39 cents per share, because we had placed the trade at a debit of 61 cents per share. Thus, we would have had a total profit of $390, making a 64% return on investment in 17 days. That is, we made $390 by investing $610. So we would have made the 100% of the maximum potential profit for this strategy. Here we can see the numbers of our example. The strategy consisted of buying 10 Microsoft puts with a strike price of $24 and expiration in November 2011 at 18 cents. Selling 10 puts with a strike price of $25 and same expiration at 38 cents. Selling 10 puts with a strike price of $27 and same expiration at 1.44, and buying 10 puts with a strike price of $28 and same expiration at 2.25. That is, we placed a 24, 25, 27, 28 long put Condor times 10. The debit paid is the difference between the premium paid and the premium received. In our case, 0.18 plus 2.25 minus 0.38 minus 1.44, which is equal to 61 cents. Therefore, our investment is equal to 0.61 multiplied by 100, which is the cost of the strategy per contract, multiplied by 10, which is the number of long condors we entered. That's a total of $610. This money is debited from our account. The initial margin required is equal to the 100% of the total debit paid, that is, $610. This is the minimum amount of money that must be deposited into our account in order to open the position. The maximum profit we can make is equal to the difference between the strike prices of the lower body and the lower wing, minus the debit paid, multiplied by the number of shares. That is $390. If we had sold at 0.01, bought at 0.02, bought at 0.95, and sold at 1.95, we would have made a profit of $380. On the other hand, the maximum loss that we are exposed to is equal to $610. That is, the total debit paid. Regarding the break-even points, break-even point 1 is equal to the strike price of the lower wing plus the debit paid. In our case, 24 plus 0.61, which is equal to $24.61. On the other hand, break-even point 2 is equal to the strike price of the higher wing minus the debit paid. In our case, 28 minus 0.61, which is equal to $27.39. Here we can see the order we must enter to open the position. It is in order with 4 legs. Leg number 1 corresponds to the higher wing and consists of buying 10 Microsoft puts with a strike price of $28 and expiration in November 2011. Leg number 2 corresponds to the higher body and consists of selling 10 puts with a strike price of $27 and same expiration date. Leg number 3 corresponds to the lower body and consists of selling 10 puts with a strike price of $25 and same expiration date. Leg number 4 corresponds to the lower wing and consists of buying 10 puts with a strike price of $24 and same expiration date. The entered price is given by the difference between the purchase and selling prices, that is, the premium paid minus the premium received. In this case, 0.18 plus 2.25 minus 0.38 minus 1.44, which is equal to 61 cents. This is the money expressed per share that will be debited from our account when the order is filled. On the other hand, here is an example of the order we must enter to close the position. It is an order with 4 legs. Leg number 1 consists of selling the puts of the higher wing. Leg number 2 consists of buying the puts of the higher body. Leg number 3 consists of buying the puts of the lower body. And leg number 4 consists of selling the puts of the lower wing. The entered price is given by the difference between the selling and purchase prices. In this case, 0.01 plus 1.95 minus 0.02 minus 0.95, which is equal to 99 cents. This is the money, expressed per share, that will be credited to our account when the order is filled. Here we ended with the chapter Long Condor. In the next chapter, number 23, we will analyze in detail the long iron condor strategy.